So I think we'll make a start. Thank you everyone for joining us for our Investing in Property webinar. Originally, we had a plan to talk about property investment and property development, but in preparing the slides, we realized that this was a bigger topic than we first expected. So we're going to split this into two. So this first one's going to be on property investment, and we'll discuss development further in another webinar, which I'll make sure we will contact you about and get the details. So today, our presenters today will be myself and Shannon Smith, who's the founder and director of Smart Business Solutions. I'm sure most of you are aware Shannon has a keen interest in property and property development, and likes to share this interest with the client base and anyone who will listen, which is why we're here today. And we have been getting some really good feedback. We've been doing some other property webinars, particularly around Smsf and financial planning, and we're getting great feedback. So we're continuing with that. And to continue to share our interest in the possibilities that are out there for property development. So I'll just, before I hand over to Shannon, just a bit of housekeeping. I'm sure we're all used to Zoom by now, but if you've got any questions, please put them in the Q&A, and we'll get to them either through the webinar or at the end. But for now, I'll hand over to Shannon, who can kick us off.
Thanks very much, Paul. So today what I want to cover, I guess, in going through and look at it, if you think about what Australians tend to love property, as Paul said, I do love property and I do talk about it a lot. I am not a licensed real estate agent, so I'm not going to be telling you which property to absolutely buy, because I am not a licensed real estate agent. And I guess when we look at it, Australians have always had, it seems to be this fascination with property. I don't know what it is, but the rest of the world tend to consider property as this growth asset and a high risk asset. It could potentially be high gain as well. In Australia, we tend to be so much more comfortable with property, and I guess this assumption that, oh, it's always going to go up. At the moment, we're seeing it going up and up and up. And we always, I guess probably the last 15 years, everyone's been saying, when's that bubble going to burst? And none of us seem to have seen that at the moment. Maybe it's easier just because I guess with houses, apartments, etc., you can kind of, I guess, go and stand on the property there and know that the property exists versus, shares, you can't touch it. So maybe it's something like that. But it is important to understand when you're looking at property and how investment in property works and making sure it is right for you, because it's not, lots of different investment options that are available may not be, right for everyone. It's depending on your particular situation. So I kind of was looking at the different aspects, and we frequently get people contacting us and saying, hey, I'm just going to buy a property, which entity do I put it in, or how do I structure it? And I usually actually come back to a lot more questions than giving them straight out then and there the answer. So I want to cover today looking at your property investment goal, having a look at your structure options, the types of property, and then it isn't a one size fits all. And that's where I'm really going to go into some of the numbers and actually go through as to how the different types of properties, etc., come out, and what does that mean from a numbers point of view once we go through that. So to start up on your property investment goal, and often I guess when we get the phone call, Paul and I will be saying, okay, well, what is your goal? Before we can give you an answer, we need to actually know, well, what is your goal of this property investment that you're looking at trying to undertake? So I always say to people to really do your research and be prepared and start thinking about, it's a really great way to build your wealth, but it does carry a certain degree of risk. And before making any property investment purchase, you really need to carefully evaluate the benefits and the risks to decide whether or not it is a viable investment for you and what your plan of attack is. And as I go through some of the numbers, that'll start to make a bit more sense. But really looking at, with the property, you're going to have less volatility. I guess property can generally be less volatile than maybe say shares or other options. Income, you are potentially going to earn this rental income if the property is tenanted. And capital growth is obviously looking at that values going up over time as well. Your tax deduction wise, you get to offset the property expenses against some of the rental income, including interest, which actually may give you some good benefits. And we'll talk a bit about those types of benefits that you might be able to get in negative gearing. You also have a physical asset, which I think there's a lot of people when you're looking at, should I invest in shares or property, this ability to be able to touch this physical asset is usually quite a big pro. And there's generally no specialised knowledge in a sense required as far as, you know, if you're looking at investing in shares or the stock market and other aspects. But this is where I guess I want to help give you some education on it so that you really can make an informed decision. Some of the, you know, I guess the negatives or the cons that might come along with it is that, you know, the rental income, depending on the yield, may not always cover your costs. The interest rates, whilst they're great at the moment, you know, I know when I bought my first house, the interest rates went from honeymoon rate of 5% to 17.1%, literally overnight when I came out of that honeymoon period on my home loan. So interest rates do go up. We are actually seeing the lowest rates at the moment. And I'm seeing a lot of people working with Carly, our broker, really locking those interest rates in for, you know, whether it be 2, 3, even up to 5 years at this lower rate. Now, there will always be some risk that you have a vacancy and that you don't have a tenant. And you do have some inflexibility that if you want to actually grab some cash from this investment you've got, you can't just sell off a bedroom, unlike a parcel of shares you might be able to. And property can go down in value. And now I know the property market's going crazy at the moment, but I actually still have even seen in this market, in the wrong locations, where property has actually lost value and someone's been happy to just get rid of it, or at least just get their money back on it. And there can be high entry and exit costs. So there are some pros and cons that you really need to make and do your research on and try and understand, well, what is it that we're actually trying to achieve, and be really clear on your goal. And the reason I say this is that what's the best tax outcome, what's the best structure, is really going to be heavily dependent on what your overall goal is for the investment strategy that you look at. I always say people spend so much time planning their kitchen renovation, but what about spending, you know, the time on looking at what you're doing with this investing in the property and spending a lot of money? I mean, let's face it, properties are really expensive. So what are your short-term goals and or your long-term goals? What are you hoping to achieve? So some of those strategies that, you know, when I'm trying to dig down on this with clients on it is, are you looking at buying this property and just holding it? So you're going to just buy it. And sometimes you could even say it's like that land banking, but you might just buy it and hold it and say, well, look, in 10 years, it's going to be worth more. I just want to get into that particular part of the market and wait for it to rise as the values go up, and then potentially sell it, getting, you know, rental income and to help cover a bit on the mortgage. Others could be looking at the property to say, well, actually, I'm going to rent it out for a few years, but I really want to renovate it and then potentially sell it. So that might, you know, change what you're looking at. Others might be looking at it really from a capital growth perspective, so that you might zero in on a market that you expect is going to have significant capital growth over a shorter period of time. So the buy and hold tends to be, I'm buying that property in Mornington and I'm just going to sit on that for the next 10, 15 years and hold it because I think it's going to go up in value. Whereas capital growth might be, you've got a little bit of access to a crystal ball of knowing where is that high growth pocket going to be, but doing that research on where that might be and buying it at a point where you might get a quicker than a buy and hold situation where you're getting into the market. You know, when they, I guess, when you look at some of the areas like the growth areas we've seen over the years around your Berwick and Narre Warren and all of those areas now, if everyone had told us probably, you know, 20 years ago that was going to take off like that point, I guess when Cranbourne got the train line out there. So there's those types of aspects that, you know, you need to know a lot of that research or that information. The other bit could also be, you know, when people say to us, I want a property so I can negative gear it. And looking at that, so we'll touch on negative gearing, but there's one thing I really need to remind you. When someone says to me, look, I want to negative gear on it, I look at that and I actually go, well, actually, how does that then link in with the other goals? So there can be a few different goals. And one thing I really stress a lot about negative gearing is that negative gearing without capital growth is really just social housing. And I can speak about that from experience, which is probably why I drum on about it by so much as well, in that I did get a property at one point, which I thought was a fabulous negative gearing. And I did actually think I did my research to think that it was going to get a lot of capital growth in that particular location. And I was actually wrong. And so the minute I realized and I saw that other properties were selling at the same price as what we'd all purchased, give or take, 8 years ago, I got out of there and managed to sell it because it had really strong yield on it and had the negative gearing aspect. But what I realized that there's no point in having negative gearing losses if you don't have the capital growth, because then really what I was just contributing, I thought, to the social housing and the rental pool of properties that were really available. So I'll pass you over to Paul to go a bit more about negative gearing as well.
Thanks for that, Shan. Yeah, so negative gearing, we hear a lot about that, this this term in the press, and basically negative gearing means that you are making a tax loss. You are making a loss on your property in terms of tax purposes, and therefore you can, if you're holding your individual name, you can get a tax deduction for that in your individual name. So for example, if you have a loss over the year of $5,000, you can deduct that from your taxable income, which depending on your tax rate, but if you're on the 39-cent tax rate, that's going to be save you close to $2,000 in tax for that $5,000 loss. So, but it does mean you're making a loss. As Shannon pointed out, you are making a loss for tax purposes. Now, that doesn't necessarily mean you're making a loss overall, because one thing that isn't considered in your annual tax return is the market growth for that property. So if the property goes up by $50,000 in a year, you're not taxed on that. So that's why it's really important, as Shannon said, to make sure that you are getting that capital return getting that capital return on your property, so that you're not just negative gearing. Yes, you get the tax deduction, but you're getting a tax deduction because you made a loss. So you're actually getting overall value and adding to your overall net worth and net wealth. Another important point is that there are tax items that aren't necessarily related to cash. So an example of that is depreciation, where you will be able to depreciate over the course of the year, but you're not necessarily spending cash to replace that asset. So therefore, you are making a tax loss, but you might potentially, and Shannon will show examples where your tax loss, you might actually making a profit for cash purposes, but getting a tax loss. So that is absolutely possible. But again, you need to do your research and make sure that is going to be the case. In terms of depreciation, so depreciation works as it would for normal businesses. You don't get the instant asset write-off to immediately write off assets. But you can, if you purchase new assets, you can depreciate them over a period of time. Normally, this is done for an investment property. Normally, this would be done by a quantity surveyor who will prepare a tax depreciation report, and will detail that and make sure that you get every single possible deduction there that you can claim. It is also important to note that there's some changes from, as per the slide says, from 2017. That means that it basically means that if you're purchasing a property and those assets have been used before, you can't get a depreciation deduction for that. So for example, if you're purchasing an existing property, you can't depreciate the oven, the appliances that are in there because they've been used before. But if you purchase a new appliance or new fit out, then you can depreciate from there. So they're the changes there, which can be significant and just need to be factored in when you're considering what kind of potential negative gearing that you would be up for. Just want to talk now a little bit about just knowing your budget. So before you invest, you're going to need a deposit of at least 10 to 20%, 20% to avoid mortgage insurance. So if you haven't got that, you need to obviously factor that into your budget as well. You'll need cash up front for things like stamp duty, for legal and conveyancing fees, insurances, maintenance. You could have maintenance issues straight away. So you need to make sure that you do have enough cash on hand, and obviously for your interest and borrowings. Consider how you're going to structure your loan as well, whether it's going to be fixed versus variable, whether it's going to be interest only, or you're going to be paying the principal back as well. Really important to go through that budget in detail, but so that you know you've got cover there for any surprises. As Shannon mentioned, potential interest rate increases? Have you got enough to cover a potential interest rate increase of 1%, 2%, or whatever it may be? Are you financially in a position where you can cover if there's urgent repairs and maintenance needed to a property, particularly if it's an old property, but I guess even new properties could have this. So really to make sure that you've got that buffer even for potential unexpected items as well. And just want to talk a little bit about structure options as well. So this is probably one of the most common questions that we get is, what entity should I use to purchase the property? So one of the most common is in your individual name, and this is where you get that negative gearing benefit, because if any rental loss, you can apply directly against your personal individual income and reduce your tax in that manner. Important to note though that if you are purchasing a property that's going to have overall growth to the net value of the property, which is obviously the aim, then when you sell it, you're going to have a capital gain in your individual name. So for example, if you've got one spouse on a really high income, and one on a low income, then the high income spouse will often want the negative gearing, but they're also going to be stuck with the capital gain when you sell. So that can be a potential problem that needs to be considered when you're buying the property. So how long are you going to be holding the property for? If you're going to hold it for a long time and maybe sell when you retire, that might not be such a bigger issue, but it's certainly an issue that you need to consider. The other option is an investment entity. Commonly, in terms of an investment entity, we would recommend a discretionary trust. A discretionary trust will allow you to, among other things, so it will allow for asset protection and some other benefits, but importantly, it will allow you from a tax perspective to distribute profits to particular members of the family group that are on lower taxable income. So that can be really valuable, particularly in terms when you do if you have a high capital gain, then you can choose where that capital gain will go in that year. So that can be really advantageous from a tax perspective. But the downside here is that any losses in that trust will be trapped in that trust and cannot be offset against other income outside of that entity. So it can be offset if the entity has other income, and it can be carried forward until the capital event occurs and you do have income. So you don't lose the losses, but it's trapped in that entity, so you can't negatively gear against your own personal income. So that is a downside to that. Obviously, joint owners and tenants in common, so that's a possible. You can have, most common obviously is the husband and wife or the spouse ownership. Main point here is that all your income and your expenses are split in the same percentage of what you own the property. And so if it's 50-50, then income and expenses will be split down the line 50% each. There's no ability to put more expenses on one side of it rather than the other. So it is quite strict with the ownership percentage there. The other possibility is an SMSF, really great, particularly for commercial property. If you're a business owner, there's some really good advantages there, but also available for residential and other commercial property as well, not just your own. We have done a separate webinar on purchasing property in SMSF, so we definitely recommend that you take a look there or get in contact with us, because there are very specific rules around owning property in SMSF, so you need to really understand it, and it is a separate webinar in its own right. So we'd definitely recommend further research if that's something that you might be interested in.
Right. And so then you want to look at, well, what are the types of property that you might be wanting to looking at investing at. And again, this will come back to ultimately your goals and what is the goal of actually why you want to look at property investment. And it may change over time as to the types of property that you invest in. Even when you are actually looking at investing in the different types of property, I look at, well, finding the right property. So what's the type? Do you want a commercial property or a residential property? Do you want a unit, a freestanding house or a townhouse? And then once you've established what that is going to be, do you want a new or established particular home or commercial property? And then really looking at, I guess, then the area that you're looking at buying in. And the reason why, when you're looking at investing in property and thinking of your overall strategy, like, why do I want to invest in property? What is my goal? What am I hoping to achieve? This may actually help you either to, kind of influence you as to what type of property you may be wanting to look at, that, but also it may actually help you to think about, well, actually, I want one of each. I want a commercial property and I want a residential property. And then you might looking at, well, do I want a new property or do I want an established property? Maybe you end up with one of each of those types of areas. So really trying to understand what are the different properties and what are the different characteristics and how that would impact, going back to what Paul said about knowing your budget and knowing your cash flow. So that's why we'll go through the numbers further on in the presentation, because it really comes down to where you potentially are at the different stages in your investments life cycle and where you're at and what your financial position is to be really looking at those. So some of the differences with commercial and residential, some of these key differences that I would see is coming down to, why would someone want to be investing in commercial over residential? I guess you can look at the lease agreements. Commercial, the leases tend to be for a longer period of time compared to a residential lease. A lot of commercial leases tend to be at least 5 years, could be 3 years with 2 other 3-year options on it. So once you get that tenant or that business in there, often people are signing up the business owner as a director's guarantee. Hopefully there's some equity behind there so that you've got that kind of comfort from that perspective. Whereas when you look at residential, those leases could be 6 months, could be 12 months, or it could be a month-to-month type situation on the lease. The vacancy with commercial, I guess the benefit of the longer term lease, once you find a tenant, you're all good, but there can be longer periods between the tenancies because businesses aren't just moving in and out of different businesses. A business to move their business location is not just about, I'm going to move for the sake of saving $100 or $200 a month rent, because the actual relocation process, the rebranding, getting all of the details updated, may be something that they actually it's too cost prohibitive to just move for the sake of a few $100 discount on the rent. Whereas residential, you generally have shorter periods. At the moment, the residential, I don't think there's hardly any vacancy. And the other thing with the vacancy on a residential, if you're not getting tenants coming, the agent may reduce the rent by $10 or $20 a week, and you'll find a tenant straight away. You've got that flexibility. Whereas on the other side with commercial, they're not going to be doing that as well. On a commercial, often you'll have the GST will apply to the purchase, potentially the income and expenses associated with it, so that you may actually having to register for GST, which may have been something that you actually didn't really want to go into doing when you're going to an investment side of things as well. And then maintenance from a commercial perspective, what a lot of landlords love about commercial is you don't pay any of the expenses, the tenant pays, and the maintenance and all of that is generally covered by the lessee. So it's just, you can wipe your hands off that part of it. Whereas residential, how frustrating it is when they actually, the hot water service is broken, or, actually I've got one of mine just the other day, I got an email saying, oh, we're getting condensation inside around the windows. And, can we have someone out to kind of have a look at potentially fixing it? And I thought, well, maybe they could just open the windows occasionally and you wouldn't have that issue. But, you get those maintenance issues with some of the residential. Interesting thing about commercial, what's going on at the moment from a numbers perspective on commercial properties is they seem to be getting quite high net yields for a lot of properties, not all of them, obviously being general, but interest rates on commercial are down as low as less than 3%. I've seen been between about, I think, 2.64 till 3% interest rates on commercial property loans, which is just unheard of. So all of a sudden, what you used to see is rental yields of 7 or 8%. Interest was, give or take, a few years ago around that 7%. So you kind of had a net. But we're now actually seeing a 4% gap. If you're lucky, it was 2% in the past. And so at the moment, I guess from a good cash flow perspective, the commercial is looking quite attractive. And then you don't have a lot of these ongoing costs that come with it because the tenant is actually doing that. On the residential side, and I'll go through that more on the numbers, but I did just want to highlight the differences because in the past, I guess the gap between the interest rates and the yields on commercial seemed to get a lot closer, and there wasn't much of a gap, which is why, from an investment perspective, some people do prefer the commercial on being able to actually get yourself to a point of positive gearing in a shorter period of time than you would that of a residential. So you're going to weigh up commercial or residential. You might go for one of each to balance your risk, so to speak. But then also talking about the differences in the new, I guess, looking at new properties versus established. Now, Paul talked about earlier about the depreciation benefits. Now, just know that with the depreciation benefits, they are available for commercial. So the new rules are really restricting the residential side of it. And some of you may recall the last number of years, the government was really focusing on negative gearing and whether they would get rid of negative gearing. Now, many years ago, they did get rid of negative gearing. They brought it back in again because negative gearing, as I said earlier, was a little bit like social housing. In a sense, it was a variation of giving some form of social housing. And as I said, you need to get the capital growth so that you're not doing social housing. But by having negative gearing available, you're actually making a wider pool of properties that are available for rent for those people that actually, you know, there's a lot of people who maybe can't afford to buy a property or actually just don't want to buy a property. They're happy to rent. So having that available from that perspective and that negative gearing side of things is actually good for the, I guess, good for the economy and the availability of property. So when they did get rid of negative gearing and brought it back here, now there's a lot of pressure that came in recently over the last few years. I guess as a kind of, I wouldn't even say halfway point, what the government did bring in is they said, well, look, what we'll do is we'll change the rules on depreciation benefits, no change for commercial properties. But as Paul said, on residential, we'll change the rules, which basically meant if you bought a new property, you get the full benefit of all the depreciation. If you buy an established property, you don't. And what they were trying to do is, I guess, make it so it wasn't as attractive to buy that, you know, house down the road in Mornington that another family would want to buy. So they're trying to kind of, I guess, balance the property growth, I guess, on that side of it from making it not that all the investors were buying a lot of those. I guess with the new, you know, tenant appeal easy when, you know, getting it rented out. The protections that are available too, you've got builder's warranty insurance, you know, 7 years there. Generally low maintenance because it's fairly new. Depending on it, it could be the security system, you know, everything's else a lot more. There can be some, depending on the situations, there can be some government incentives available. I'm personally not the biggest fan on some of those new properties that are linked with, like, I guess they've got the NDIS and a few of these other things. I wonder about the long-term ability being able to get the capital growth and selling those properties in the future. Because whenever I'm looking at property, you know, whilst you've got to go into it from a numbers perspective and an investment, it has to be something when you're talking residential that someone else will want to buy and not just for an investment in the future. Sometimes the new properties can be a bit less affordable and limited value adding if you're looking at that renovating, and potentially could be a greater market risk depending on where you're buying. If you're buying in a new area that you're hoping will go up, you know, you're buying it at a time that may not be where you don't know the crystal ball on what's going to happen to those properties. Looking at the established, I guess they tend to be a bit more of a known commodity. You know what you're getting, so to speak. Could have the renovation potential. I know we're all watching our property shows and thinking we can all do these renovations ourselves. Could be more affordable depending on the property. You've got the history, and then you've got some negotiating power as well, and potentially the capital growth depending on the land size as well that might be able to look at. Maintenance is going to be a big one, and I actually think this is going to be a bigger issue going forward. I think we're going to see you know, a flood of investment, I guess a flood of properties coming onto the market, established homes that really need some work. And if they are purchased from an investment perspective, you need to be aware, because there's the new rules in relation to rental properties. The new rules actually for tenants means that you do need to actually undertake certain checks each year on the electrical. So there's certain new standards that have to be maintained of a property. And I think we're going to see more and more of these really old properties that are still being, still have tenants in them at the moment, but the landlord's now being told, well, actually, we've had that check done on the electrical and you need to rewire the whole house because it's not safe. You can't rent it unless you rewire. So I think that we're probably going to see some of those coming up. So it's worth having a look at if you are looking at buying a property, do get the building inspections and have that check, so that when you are buying something that's established, you're not buying it and then finding out you're having to spend a lot more money just to get to a satisfactory requirement for being able to rent it, now that these new rental rules that have changed and putting more restrictions on the quality of what you are renting. Generally speaking, there can be a lower rental return, mainly because the prices have gone up so much on them, and the rents have gone up, but not to the same extent. And could be less appeal, could be, could be more attractive. It depends on that. And there are lower depreciation deductions. So as Paul mentioned earlier, and you'll see this in the numbers when I go through it, that you can't actually depreciate. When you bought the house, it had an oven that was X number of years old, and you bought the house on the basis of that oven being, 5 or 10 years old. It wasn't a brand new kitchen. If it was a brand new kitchen, so it's kind of incorporated in the property. And so that's where you get these lower depreciation deductions. You still have the capital works deduction. So that one's still available, but you do get these other lower depreciation deductions, which will reduce the amount of your tax benefit. Okay, so now I want to talk about, I call it the one size does not fit all, and that is going to be something to really think about. So that often when we have clients contacting us and they say, look, I've just built a property, I want to put it in this particular, or which entity should I put it in? I'm usually, as I've talked about earlier, going back and actually saying, well, what's your goal? What's your reason? Now I'm going to go through a few different numbers. What I will do is we will send the presentation out with I'll PDF the slides with full detail, so you can kind of see the difference in the numbers. And this is why it really comes down to what your ultimate goal is and what you're trying to achieve. Because unfortunately, we would love to have your cake and eat it too, but sometimes this isn't going to happen from we want the tax benefit, but when we want to go to sell the property, we don't want the capital gains and things like that. So I'll go through each of these calculations, and this is where, whilst I'm not a real estate agent, I can't tell you which property to buy. I can certainly evaluate and tell you how it works from a numbers perspective as to what the benefit's going to be for you, and what the cost or cash flow is going to be, outflow, and how you might be able to achieve some of those goals on it. So let's have a look at a new residential property. I've assumed an apartment. Now, is buying an apartment off the plan the right outcome for you? Now, look, there's some pretty crap apartments out there. So when you do your due diligence, make sure you really look into buying those types of properties. And this goes with new apartments or any property, actually. You want to buy something, and especially, I guess more so with apartments, a lot of people are investors into apartments, but you want to buy an apartment that actually ideally someone would actually want to buy as an owner-occupier, whether it be a downsizer or a young professional who would go, that is the kind of apartment that I want to live in and call home, rather than just that transient, I'm just going to live here for a few years, and then you get the next investor. Because if you do that, you're going to get all of the market potentially interested in buying your property when you go to sell. And that's really, really important. Otherwise, the investor market, that's just a small portion of the market. So those, I call them dime a dozen apartments, where there's a 2-bedroom apartment in a building for sale, and at the same time, there's another 10, 15 of the same type of property. So always looking for something that is potentially a bit unique, better quality. Quality is always going to stand the test of time. I cringe every time I hear someone say, I just bought one of those apartments in a student housing building. I absolutely cringe. Who's ever going to want to buy that apartment to live in the future? So you're only ever going to have an investment. You're not going to get an investor buying it, and potentially they're looking just at yield. I'm always stressing, hey, yield's great. I want capital growth as well. I actually want my cake and eat it too. I want great yield and capital growth. But if I can only really get one, I want a reasonable yield and I want awesome capital growth, because capital growth on such an asset is always going to pay you so much more in the end from a net return than the extra 1 or 2% from a yield perspective. So that's something we're always going to be looking at. So if I'm looking at the numbers now, I'm just going to look a bit to my side, because I've got it up on my big screen because there's a lot of numbers there. So when I'm looking at these numbers, so new residential, I'm assuming an apartment, just for as an example, 870,000. You've got your purchase costs. rental yield of 4.5% is pretty reasonable, standard reasonable. I've had others that end up getting a bit more. I've looked at an interest rate of 5-year fixed, and this is where we kind of work with clients, and obviously we can do the broking now as well, but we work with clients to kind of understand what's your full picture when you're going into this investment. If you're going into this investment on a basis of you want to get money into an investment, you want to start getting a return coming back and really starting building capital growth, and you want to potentially buy another one. Let's just say in another few years you want to buy another property. It may be commercial, it may be residential, or variation. Then I might be looking at it and discussing with you and saying, well, actually, from a cash flow perspective, this interest only is probably the best outcome. And I might look at saying, well, let's get a fixed interest rate for 5 years. It's a known commodity. And for the next 5 years, that's what you're going to be paying. So when I'm looking at, we've got our tax purposes. So this is what you're going to pay tax on or get a nice big tax benefit for. So your rent received, you've got your cash flow, and this is what's important about an investment property. A lot of people go, great, I've got negative gearing, I'm getting money back from the tax man, but you need to be able to afford it from a cash flow perspective, the money coming out of your pocket every week, every month to pay that. And that may be sometimes, some people say to me, oh, but I really want to buy that property down the road, in Mornington around the corner from me. Well, that's great. And even if you got the property for $870,000, what's it going to do to your cash flow? And are you in a position now to be able to afford that cash flow going out of the door? So you've got to think of the tax benefit, and you've got to think of also that cash flow and the position you're in being able to afford it at this point. So looking at the numbers, rent received, now we have the same rent, same in cash and same in tax. We have interest expense, which is the same. But what we do have difference is for tax purposes, you can't claim a deduction for your principal on the loan. And that's going to be a cash outflow. Now, if you do interest only, you're not going to have that. Depreciation, and this is what Paul talked about earlier, where we actually have depreciation. There's capital works, which is the cost of building the property or the house or the apartment. And that's at 2.5% a year. And that's usually really nice, sizable deduction. And then you've got your furniture and fittings. Now, the furniture and fittings in a new build can be depreciated. And that's another great, nice tax deduction that, as you can see, is not doing anything on your cash flow. And that really helps give a nice big tax benefit from that perspective. You don't get the same, as Paul talked about earlier, you don't get the same benefit with an existing property. Water rates are the same, shire, body corporate, renting, letting fees, etc. So what we're looking at here from a tax perspective on this particular one, we're looking at a negative gearing loss of $8,604. Now, actually, this one's based on a real life example. When I did this about 2 years ago with a client, the interest rates were very different. The loss was a lot higher. Look, it's always better to not have losses, but what this means, this negative gearing, you can offset against your normal other income, wage income, business income that comes into your name. Tax benefit at 47 cents in the dollar. This is really important to look at, depending on what cent in the dollar your effective tax rate is. We look at it and say, well, what is your benefit going to be? So they're getting a tax credit of $4,044. Now, I look at that and say, well, that's very kind of the government to pay $4,044 tax benefit and towards your property. So from a cash flow perspective, what's our net cash flow position? Principal and interest, we've got a net cash flow of $7,269 before the tax benefit. After the tax benefit, we have a net cash flow perspective negative of $3,225, so $62 a week. So if you buy this property and you want to do principal and interest, you're going to be out of pocket after the tax benefit of $62 a week. And you may say, well, that's fine, I can do that. That's not an issue. If you do interest only, you're actually going to have a positive cash flow. Now, that can be a real benefit for some clients that might say, well, look, I don't want to pay the extra onto the principal. So let's just say we do 5 years. You've got 5 years at $14,482. I don't want to do that. I want to save that money in a sense myself. And I want to be in a position where I then can reinvest that money into a new property or something else. So that's why you've got to weigh it up. Sometimes actually when a client gets it, and remembering this is general advice, not always for every property, but often if we do a fixed rate of even for 3 years or 5 years, just as an example, we might do that as interest only. And then after the 5 years, convert that to principal and interest where the rent's gone up. So often we can still get to the same net cash outflow, if that makes sense. So you've got a net cash outflow going from positive here. So anytime it is positive, I say to clients, just assume it's nil. Don't even bank on the positive. I just do that to be conservative. But then you've got $62 out of pocket here. So that's where when you're getting strategic advice around the investments, we can really help move things around a bit that can help you from that benefit. Now, if I look at the existing residential property, so often people will be saying, should I invest in an apartment or should I invest in a property down the road? Now, I obviously always go back to their goals. What's your intent? If they want to develop on the property in years to come, then that's not going to be an apartment. So I always look at what their intent is. But if it is a case of, I've got money now, I want to do something, I want to invest it. I had actually a client we were talking with just yesterday, and they really want to save tax and they've got some money to invest. And so they're like, how can we save tax and invest some money in property? But they actually said, oh, we can't afford to buy near us. It's just ridiculous prices. So that's where you've got to weigh up the investment that you're actually undertaking and how that pros and cons fits into it. So if we think of an existing residential property, a lot of established homes, etc., you're probably lucky if you get 2.5%. That can be kind of concern. That's a bit, could be 2.5%. Rents have gone up a bit, but let's just assume 2.5%. All other factors we're assuming are the same. The only difference will be the depreciation will not be the same. I took off here the fixtures and fittings depreciation, so that's reduced. And actually, if the building is really old, you actually may get no depreciation. So the building works, it may not qualify, and you actually may get zero depreciation from that perspective. You've got your repairs and maintenance. Now, I've just highlighted it to say that, look, actually, if you've got an existing property, those repairs and maintenance can be very high. That can add up on over time. So what you've got here is you've got a situation of, yes, you've got a tax loss here of 8,604. You've got a bigger tax loss if you've got an existing property because actually you've got you've got less rent coming in is probably the key one. Yes, you've got less depreciation, but most likely the less rent coming in. So you've got a tax benefit here, which is $8,608. Now, that's great. You say, well, hang on a minute. I'm getting a better tax benefit than I am with the other. But we've got to look at the cash flow as well, because it's not just about always the negative gearing. We've got to look at the affordability side as well. And you're only getting a bigger tax loss, which is not always great. You're only getting a bigger tax loss because you're actually getting less rent, which is less money, less cash. Now, let's look at the actual cash flow impact of this. You're talking about a net cash outflow of $23,000 if you do principal and interest, or $8,847 a year. Yes, you get your tax benefit difference here, but you're talking about a situation where if you did principal and interest, you would be looking at an out-of-pocket of 15 versus 3,000. And so this is where you've really just got to think about, where are you at in your investment? What is the purpose of your investment? You're never doing anything just for tax. But you may actually say, look, I want the tax benefit. I want the government to give me that money from a negative gearing. It will reduce your taxes, especially if you're on salary and wages and you don't have many other areas that you can be more flexible on. So it will reduce your taxes, but at what cost does that have to your family personally? And that's why sometimes the apartments work really, really well from that perspective. And, you know, my husband's an employee. He does not have much flexibility when it comes to tax deduction. So I just like to load him up with those properties, much to his shock and horror, but no, load him up and I get those tax benefits, and I'm selecting properties that are giving me the capital growth. So not just your mainstream apartments that, you know, those types of situations. So that's what I'm trying to do in being very selective from that perspective. So with your existing, it comes down to net cash flow and what that situation might be. And this is if it's in your own name, as Paul talked about earlier in the different structures. If you had this in a family trust, because you said, okay, I want to put it in a trust because we might sell it after 10 years, you're not going to get that tax benefit because that loss is going to be kind of captured in that trust. So you're not going to get that tax benefit. That's only if it's in your name personally. So you would need to have the ability to fund $23,000 of out-of-pocket cash per year for that property until you actually get to a point where you do something else with it. So this is where a lot of the strategy can come in. Also, you could look at buying a residential property in an SMSF. So if you don't have access to the funds outside, but you're like, I want to get into property. We did a presentation, as I mentioned earlier, on this, so we will send the links out for that as well, on buying property in an SMSF. SMSFs can buy commercial or they can buy residential. You just can't use a residential if it's sitting in your SMSF, but they can be a really great tool in being able to invest in property using that the funds that you've got in there. So again, similar situation, you can get the loans up to 80%. Sometimes it will be at 70%, depending on your track record, I guess, with putting super contributions in. Interest rate will be slightly higher than what you are paying outside of super. Rent received, so using the same scenario, you've got your interest, you've got your depreciation, you've got your tax loss here. Now, the tax benefit's only at 15 cents in the dollar because that's what your super fund pays. So your net cash flow from this, if you did principal and interest, would be $5,000. Now, one would hope that the property goes up by more than $5,000 a year from a capital growth perspective. Or if you actually did it on an interest only, which I often say to clients, hey, let's just do it on interest only for a few years. Let's get it until the rent comes up a bit to cover the principal and interest. And it also enables you to invest in something else as well. Commercial property. So commercial property, yields are different. So I talked about earlier, gone are the, actually there used to be the days where commercial property was 8% yield, which was fantastic. That's gone down a bit. Some are still up at that. So if you're really hunting around for the property, some areas, Mornington Industrial Estate has just gone crazy and those yields have really gone down. So I just use 4.5 based on that's what they're getting in a lot of those properties there. But there are still some really good pockets to be found that if you can get yields of 7 or 8% and you look at your interest rate that you're paying at the moment, your interest rates for commercial are around about 3%, and that's a great outcome. So we've been working with a few clients. So our colleague on our lending, she can help with the commercial loans, and that's been really, we got like 2.94 was the most recent one, which was a really great deal on that scenario. Commercial property, you'll have depreciation depending on the age of the property. If it's really old, there's probably nothing much left on depreciation. But what the beauty of the commercial property is the fact that the tenant pays all the expenses. So you don't have all of these outflows. Now, I do like to tell you, just FYI, this is my own thing that I like to do. Despite no matter what the rental agent says to you and says, oh, just forward all those bills along to the tenant, I always pay the insurance and I make them reimburse. I'm going to make sure that my property is insured so that if they've paid the bill late, I don't have an issue, if that makes sense. So I always pay the insurance and I on charge it to the tenant. I don't let the agent just pass that on to them because I want to make sure my property is insured, and no one cares about your property better than you do yourself, I guess. So again, letting fees, agent fees, etc. So looking at it, and you look at this negative gearing, well, guess what? It's not really negative gearing. Actually, I should have changed the words here. So a little bit of an error there. It's actually a taxable profit, actually. And I did update it here. You've actually got tax payable because straight off the bat, you've actually got a situation for tax purposes where your rent, because the interest rate differential, you've got your depreciation, you've actually got tax payable of 3124. So what does that mean from a cash outflow? So this little tax loss, just change that to profit. Cash outflow, if you did principal and interest, you've actually got cash outflow of 189. You've got a tax payable, so it's not a tax payable, but it's tax payable. So your net cash outflow is 3313 on the property. And again, if you do have principal interest only, you've actually got a net positive. So that's why a lot of people like commercial properties from a longer term investment, but there are some of those risks that you might be empty for a year or so if you can't find a tenant. So there's those kind of risks, but this is why people do really like it in a super fund especially. And I have a number of clients that have got like 2, 3, 4, they just keep buying more and adding on to them, that there can be that benefit from that perspective. Then we have commercial property and SMSF, one of my absolute favorites. Love this. Main reason being, again, especially those business owners, this is a great way of buying the property that you want to run your business from, because you're allowed to do that in SMSF. You can't do it for residential, but you can do it for commercial. So a really great way to do that and make your business pay all of those expenses. So make your business pay all of those. And then again, buying in an SMSF, you've got 15%, and again, you've got a profit here, you've got a tax benefit of 15, tax payable of 15% to $610. And so again, you can see the cash flow. So you can really see the benefit of commercial, not having that much in the out-of-pocket cash, but you need to make sure when you go into commercial from an investment property perspective in your SMSF that you do have some buffer of cash. I like to say 20,000 and contributions coming in, just to enable the fact that if you do have a vacancy in between tenants when it's not yourself, that you do actually have that, so that you can actually make sure you're having a look at that. So that's why when you do ask the quick question, what do I put how do I invest in a property? Which entity should I put in? This is where we do a lot of this number crunching to really try and work out, well, what's going to be the best for your overall situation. So I guess going back to a lot of this is, it really comes back to what your overall goals are. And so when we do frequently, I had it again this morning, someone's just buying a factory, not to be used for themselves, which entities should they be putting it in? And I really have to go back to, well, what is it, back to your goals? So I can help advise on, well, what structure should you be looking at from a legal ownership perspective, a tax position, as Paul talked about on the structures of whether, is it in your own name because you want negative gearing, or is it that actually, and how long are you going to hold that property? If it's going to be only 5 years, we might give you a different answer to if you say, well, I'm actually going to hold it till retirement. And then coming down to the type of property that you're looking, investing in, residential or commercial, and then looking at whether, is it new, is it off the plan, or is it existing? And I mean, when we're talking off the plan, that can be actually residential or it can be commercial as well, and looking at it, and then get advice to be able to crunch the numbers, just so that you can really make an informed decision of what it is that you're actually going to be investing, and what would be that cash outflow that you're going to be expecting, so that you're not going to get, I guess, caught out at a later point, or be in a situation where you maybe have to sell it because you're finding it financially hard to keep up with the payments if there's a gap in the cash flow. So as we said, we can help with some of the number crunching. Whilst I'm not a real estate agent, I can't help you with the exact top properties. I can really help you a lot with the number crunching on the tax side, and also the other services that we provide around financial advice, mortgage broking and equipment finance now, and insurance, and I guess the list goes on at the moment. So we can help you in a lot of these different areas to make sure that you've got all of that covered. But I guess we'll open it up to questions now and see if we've got anyone has any questions on some of these areas that we've touched on.
Just got the one question at this stage, Shannon, but hopefully if anyone has any questions, please put them through and we can answer. Yep. So the first question we have is, if you sell a property for a loss, is the loss tax deductible? So in that case, the loss would be considered a capital loss. So you would only be able to offset that loss against other capital gains. So if you don't have any other capital gains in that year, then you can carry that forward, that loss, until you have a few capital gain in the future.
Yeah. So I just got another one about can I not sell the property between spouses and sell the property? So I assume the person's asking, we do get this question a bit as well. Assume, and just clarify if I'm not articulating what your question was, but I assume the question in relation to whether you can transfer it between spouses. So few aspects on that. So main residence, you can transfer between your spouse. There's no tax impact on that, and there's no stamp duty because it's your main residence. Now, they did change the stamp duty, so transfer of an investment property between spouses, that is a taxable event. So that is a capital gains taxable event that should be at the market rate at that point in time. And there is stamp duty, and that's only been around for a few years, that you do now have to have stamp duty as well. So it's not a case, I guess that probably the person's alluding to the fact that it's not a case that you actually have your negative gearing, and once it becomes no longer negative gearing, or you're wanting to sell it, you can't just move it from one spouse to another at that point.
Another question, Shannon. What's the management and established costs for an SMSF?
So that is one. So I guess we can. We'll send you actually the webinar that we did on actually setting up on an SMSF. Comes down to, I guess, what you've got into the SMSF, what you've got property. It's going to be, generally speaking, if you've got a property, if you've got about 300,000 in an SMSF, that's going to be similar costs to what you've got in your retail super fund. So the cost of actually having it, paying the retail fund trustee, is going to be similar to what a self-managed super fund would be. If you had, say, 500,000 member balance in your SMSF, it's going to be more cost effective to have an SMSF, but you actually may not be wanting to deal with it in a sense. But if you want to invest in property, you will need to have a self-managed super fund, because you can't do that through retail funds. So I can send you the information on the costings, I guess, at a high level, but also we did do a webinar about 2 months ago on, is this SMSF right for me? And it's not necessarily right for everyone. Is there a set of circumstances when selling property in SMSF to yourself as an individual is viable? So selling property from SMSF. Okay, so there could be two scenarios to touch on with this one. If it's a commercial property, you could do that, but I probably question why you'd want to do that, because ultimately you want to be in a situation where you're building up your super, but you could do it if it was a commercial property. If it's a residential property in your self-managed super, you actually can't sell it to yourself until after you get to retirement phase. Once you're at retirement and it's in your super fund's in pension phase, you can pay yourself a lump sum pension, which would be the value of the property. So the property would need to have no debt associated, and so that you've got that net member balance. So it probably depend on the facts and circumstances, but I'd probably be looking at, well, what's the purpose of doing it? Why someone might do that in their SMSF and take it personally. It may be that they've bought, the property up in Queensland, and they're like, well, once I retire, I'm going to spend 6 months of the year living up there. You can't actually use it when it's in your SMSF if it's a residential property. So that's where someone may actually sell it from that perspective. But it's probably a good question, but probably a wider framework of questions that kind of goes with it as well. Okay, do we have any other questions? No?
Looks like it for the moment.
That's great. Oh, thanks very much for joining. And for those that were looking at property development, we did have to change to just looking at just the property investment, because there was so much involved in that. We did have, there was a number of questions on the SMSF. If you do go onto our website, or onto our YouTube channel, you'll see using your property to buy, using super to buy property. I see it as a good way to feed your property addiction by being able to have that opportunity. But there is, we did record that webinar as well. We also have another webinar coming up, getting paid. So how to get paid from business owners' perspective. So you can sign up for that. And as I mentioned on our YouTube channel, we do have a lot of all of our webinars have been recorded, and generally speaking, when we get questions from clients and a number of people are asking the questions, we do like to record a video and get those answers out to you as well. Just to introduce our leadership team, myself, we've got Paul, who you've met during this webinar, and also Daniel McCulloch as well. So if you've got any questions at all, feel free to reach out, and happy to help. And as Paul said, I'm just happy to talk to you about property as well. If you want to flick me a few property options, and we can chat about them. So thanks very much, everyone, for joining.
Thank you.
Thank you. So I guess going back to a lot of this is it really comes back to what your overall goals are. And so when we do frequently, I had it again this morning, someone's just buying a factory, not to be used for themselves, which entities should they be putting it in? And I really have to go back to, well, what is it back to your goals? So I can help advise on, well, what structure should you be looking at from a legal ownership perspective, a tax position, as Paul talked about on the structures of whether is it in your own name because you want negative gearing, or is it that actually, and how long are you going to hold that property? If it's going to be only 5 years, we might give you a different answer to if you say, well, I'm actually going to hold it till retirement. And then coming down to the type of property that you're looking at investing in, residential or commercial, and then looking at whether is it new, is it off the plan, or is it existing? And I mean, when we're talking off the plan, that can be actually residential or it can be commercial as well, and looking at it, and then get advice to be able to crunch the numbers just so that you can really make an informed decision of what it is that you're actually going to be investing and what would be that cash outflow that you're going to be expecting, so that you're not going to get, I guess, caught out at a later point or be in a situation where you maybe have to sell it because you're finding it financially hard to keep up with the payments if there's a gap in the cash flow. So you know, as we said, we can help with some of the number crunching. Whilst I'm not a real estate agent, I can't help you with the exact top properties. I can really help you a lot with the number crunching on the tax side, and also the other services that we provide around financial advice, mortgage broking and equipment finance now, and insurance, and I guess the list goes on at the moment. So we can help you in a lot of these different areas to make sure that you've got all of that covered. But I guess we'll open it up to questions now and see if we've got anyone has any questions on some of these areas that we've touched on.
Just got the one question at this stage, Shannon, but hopefully if anyone has any questions, please put them through and we can answer. Yeah. So the first question we have is, if you sell a property for a loss, is the loss tax deductible? So in that case, the loss would be considered a capital loss. So you would only be able to offset that loss against other capital gains. So if you don't have any other capital gains in that year, then you can carry that forward, that loss, until you have a few capital gain in the future.
Yeah, so I just got another one about can I not sell the property between spouses and sell the property? So I assume the person's asking, we do get this question a bit as well. Assume, and just clarify if I'm not articulating what your question was, but I assume the question in relation to whether you can transfer it between spouses. So few aspects on that. So main residence, you can transfer between your spouse. There's no tax impact on that, and there's no stamp duty because it's your main residence. Now, they did change the stamp duty, so transfer of an investment property between spouses, that is a taxable event. So that is a capital gains taxable event that should be at the market rate at that point in time. And there is stamp duty, and that's only been around for a few years, that you do now have to have stamp duty as well. So it's not a case, I guess that probably the person's alluding to the fact that it's not a case that you actually you know, have your negative gearing, and once it becomes no longer, you know, negative gearing, or you're wanting to sell it, you can't just move it from one spouse to another at that point.
Another question, Shannon. What's the management and established costs for an SMSF?
So that is one. So I guess we can. We'll send you actually the webinar that we did on actually setting up on an SMSF. Comes down to, I guess, what you've got into the SMSF, what you've got property. It's going to be, generally speaking, if you've got a property, if you've got about 300,000 in an SMSF, that's going to be similar costs to what you've got in your retail super fund. So the cost of actually having it, paying the retail fund trustee, is going to be similar to what a self-managed super fund would be. If you had, say, 500,000 member balance in your SMSF, it's going to be more cost effective to have an SMSF, but you actually may not be wanting to deal with it in a sense. But if you want to invest in property, you will need to have a self-managed super fund, because you can't do that through retail funds. So I can send you the information on the costings, I guess, at a high level, but also we did do a webinar about 2 months ago on, is this SMSF right for me? And it's not necessarily right for everyone. Is there a set of circumstances when selling property in SMSF to yourself as an individual is viable? So selling property from SMSF, okay, so there could be Two scenarios to touch on with this one. If it's a commercial property, you could do that, but I'd probably question why you'd want to do that, because ultimately you want to be in a situation where you're building up your super, but you could do it if it was a commercial property. If it's a residential property in your self-managed super, you actually can't sell it to yourself until after you get to retirement phase. Once you're at retirement and it's in your super fund's in pension phase, you can pay yourself a lump sum pension, which would be the value of the property. So the property would need to have no debt associated, and so that you've got that net member balance. So it probably depend on the facts and circumstances, but I'd probably be looking at, well, what's the purpose of doing it? Why someone might do that in their SMSF and take it personally. It may be that they've bought, you know, the property up in Queensland, and they're like, well, once I retire, I'm going to spend 6 months of the year living up there. You can't actually use it when it's in your SMSF if it's a residential property. So that's where someone may actually sell it from that perspective. But it's probably a good question, but probably a wider framework of questions that kind of goes with it as well. Okay, do we have any other questions? No?
Looks like it for the moment.
That's great. Oh, thanks very much for joining. And for those that were looking at property development, we did have to change to just looking at just the property investment, because there was so much involved in that. We did have, if you are, look, there was a number of questions on the SMSF. If you do go onto our website, or onto our YouTube channel, you'll see using your property to buy, using super to buy property. I see it as a good way to feed your property addiction by being able to have that opportunity. But there is, we did record that webinar as well. We also have another webinar coming up, getting paid, so how to get paid from business owners' perspective. So you can sign up for that. And as I mentioned on our YouTube channel, we do have a lot of all of our webinars have been recorded, and generally speaking, when we get questions from clients and a number of people are asking the questions, we do like to record a video and get those answers out to you as well. Just to introduce our leadership team, myself, we've got Paul, who you've met during this webinar, and also Daniel McCulloch as well. So if you've got any questions at all, feel free to reach out, and happy to help. And as Paul said, I'm just happy to talk to you about property as well. If you want to flick me a few property options, and we can chat about them. So thanks very much, everyone, for joining.
Thank you.
Thank you.